Okay, I want to walk through some examples in your textbook on Chapter 10. And this first starts off with the concept of net present value. If we look at this example, it says a manager has a project that's going to cost $40,000 initially. It's going to generate these cash flows at the end of each year for the next 5 years, and then the project terminates. We have to make some assumptions here about these cash flows that they happen at the end of the year. The reality is in business that these cash flows happen throughout the year, but for simplicity's sake, we're going to assume that it generated this much of a cash flow at the end of the year. Again, this is going to help us establish a tool to help us make a decision whether this is a good project to take on or not. And as long as the project has a positive net present value, which it does in this case of $7,600 some dollars, we would accept the project. So again, the cash flows are not guaranteed. This can change, and in Chapter 11 you're going to look at more sensitivity and scenario analysis, but someone had to crank through some numbers and generate some potential cash flows that they felt this project could generate based on taking on this initial investment. So let's walk through the net present value first. I'm going to go to f of x. I'm going to find financial, look for NPV, scroll down a little bit, NPV, we hit OK. The opportunity cost required for this project is 12%, so that's what their investors require. And then we're going to look at the values. An easy way to do that, again, we just want to take the positive cash flows or the cash flows. In this example, they're positive. They could be negative, but we don't want to include the initial cash flow. That's a mistake sometimes students make, but we just want to take the future cash flows because that's what we're discounting back. And if I hit OK there, it says the present value of all those cash flows is $47,000 some. But I need to remember to net out, that's where the net present value comes in, the initial $40,000 investment. So I do that and I hit OK, and that does match up to what we have in the textbook. So this project would be accepted because it is a positive net present value. All right, with internal rate of return. Internal rate of return by definition is the rate that sets the net present value exactly equal to 0. So it's as if we were to discount all these cash flows at kind of like what is that rate. If I discount them back, would exactly equal $10,010. So that's what I mean by setting the net present value equal to 0. So to do this, we're going to go to f of x, find internal rate of return, IRR. We say OK. Now with internal rate of return, you do include the initial cash outlay in Excel. So I'm going to highlight that initial cash outlay and the future cash inflows. And we see that 19%, so it does match the result we have in the textbook. If I discounted all these cash flows by 19% and add them all together, it would exactly equal that $10,010. All right. Something some managers like to do that's been popular recently is, because of problems of multiple internal rates of return, as the example in the textbook pointed out, and the pages, if we look at this, we move forward a little bit, I think it would be on page 321, and also just that we make assumptions about what we can invest this future cash flows out. Are we being realistic about that? Perhaps any cash flows that we receive here, really we can reinvest those at 10%. So a modified way to do this from the internal rate of return is to make an assumption that the cash flows can only be reinvested at a 10% rate of return. So to do this, we're going to go to f of x, find MIRR, we hit OK. The values we're going to do the same way again, but I'm going to put my finance rate in. It says the interest rate you pay in the money used in the cash flows, and the reinvestment rate. This is the more important criteria. And it says based on this reinvestment rate, it would be at a 17.446% rate of return. So, and just out of curiosity, let's just kind of show the difference here. Let me kind of highlight another cell. Let's say if I did it as the modified internal rate of return, or just an internal rate of return, let's go to IRR, just to show you this. And let's do the same thing again. And you see how it's a lot higher. So this helps readjust maybe like a true internal rate of return. All right, last thing I just want to show you is with what happens if we have two unliquid life projects. Notice this project lasts for 3 years, and should I repeat it again, or this project lasts for 6 years? Well, first thing we would do is find the net present value. I'm just going to do it for one of them to show you, but this goes just like the previous example we did. We did f of x and find NPV. And OK. We're assuming we can earn a 10% rate of return. I'm going to highlight the values, the $500 at the end of each year, If I hit OK, but again, I got to remember to subtract out my initial cash outlay. So that's $243.43. Now, what we're going to do is we're going to convert this into an equivalent annual annuity or a payment so I can make a comparison. In this case, we would want the higher PMT. As we can see, this project is better, but I still need to show you that process. So let's find PMT, hit OK. Required rate of return in this example is 10%. This project lasted for 3 years. And the present value, we're just going to put it as a negative 243.43, so it comes out as a nice positive and matches up the book. But it says this project would give me an equivalent annual annuity of $97.89. For sake of time, I'm going to do the same thing over here to just type in the net present value. But the difference here is going to be 6 years. So I'm going to find payment again. Hit OK, 10% required rate of return, but this project lasted for 6 years. And the present value in this case was negative 306.58. And if I hit OK, it matches up $70.39. So this provides you with some examples of how to calculate some of the net present value, internal rate of return, equivalent annual annuity, modified internal rate of return examples. Again, I strongly suggest that you go back in the example and make sure you can duplicate the examples in the textbook. And hopefully this video will give you a little bit of guidance how to do some of those things. And that's it.